What's going on, everybody? Welcome back to the channel. Welcome back to the vlog. Today we have, yes, a very disappointing story, a financial burden, a shit example of what is gonna be coming up in the future for real estate investors, especially those who purchased or over-purchased properties. Now, most of the properties I've ever bought have been very well undervalued, like 50% off almost. This particular one I actually thought was a really good deal, and as you'll find out, the loan terms I had were unbelievable until they got swept up from underneath me, causing a big predicament. Now, fortunately, the property that we did buy is gonna still make a ton of money, so I'm not really screwed here. However, this situation would have been a lot different for myself, for my investors, and more importantly, we would have been able to keep this property for so much longer and generate so much more income. Instead, we're gonna have to accept a lower amount of income over the next few years until we can refinance again when the rates are low. So with that said, let's dig into it. What's going on, everybody? So welcome to my sad story about my 13-unit apartment building. First of all, we all know what's happening here, right? We have interest rates rising, we have property values dropping, there's nobody really selling real estate, the economy is going down sort of in this like slow turmoil. You know, within the next 6 to 12 months, we will likely be in a recession if we aren't already in one, which I really believe we are. But let's really dig into what happened with my 13-unit apartment building where I lost the ability to get $250,000 of tax-free money. Instead, I had to bring $50,000 more to the table just to close the deal. We bought this property about 11 months ago with bridge money. Now, at the time, regular interest rates were 4% for commercial rates. Some were even less, which is really, really good, right? Right now, they're like almost 8. Anyways, we used bridge debt, we used a construction loan, we went through the entire property and banged this entire thing out up down to the T's, right? I mean, this thing is in mint condition. There are strong rents, the tenant pool is strong. We evicted 3 tenants. There's 15 parking spots. It's walking distance to the ocean. It's in a prime spot in Bristol, Rhode Island. I went to go get a refinance on this property before the rates had gone up, and I used my loan broker, who I love and does a fantastic job for me. He brought me to a bank who committed to, or wrote a commitment letter, or an LOI, a letter of intent, we should say. Had a 5% interest rate with a year of interest only, amortized over 30 years. Now, I was thinking to myself, this is fantastic. The rates are starting to rise. I'm going to lock this thing in. This is right where I wanted it to be. I was going to be able to pull out over $250,000 in cash, tax-free money. This is basically a successful BRRRR if this goes through on an apartment building, which is what we specialize in. Well, 2 days before the commitment date, the bank decides to tell me that they are no longer going to lend to us on these terms. Now, within those 2 months, from the time they told me that what the terms are going to be to the time they canceled on me, rates had increased almost 2%, right? 1.5%. So from 5 to 6.5%. Now on a $2 million to $2.5 million asset, keep in mind the appraisal came in just under $2.5 million. We're talking a lot of money difference between that 1.5 to 2% interest rate. So, anyways, they told me the reason that they backed out on the loan was because a partner of mine had a criminal history of 30-something years ago in which he served time for and hadn't had to mention it in years. In fact, after 7 to 10 years, I'm pretty sure it's not even necessary to disclose it. However, the bank dug so deep into this, found it, and told us that we were not going to, basically told us they weren't going to lend to us because of that. It's complete bullshit. What they were trying to do was to get out of a loan that they probably couldn't execute. What I mean by that is, sorry, excuse my dog. Well, what I mean by that is 5% interest rate over 30 years with a year of interest only. There's no way they can execute on that when the interest rate is 6.5%, no interest only year, 25-year AM instead of 30 AM, right? They wouldn't have been able to sell that 5% loan on the market or to a third party. They wouldn't have been able to sell that 5% interest rate loan on a third party market to somebody, so they would have had to hold it. And so for them, what I think what was going on was they went out of their way to find something so minute and minuscule to kick us off. Now, here's the kicker of this whole thing. The property's worth almost $2.5 million. I was going to be able to pull out 250 grand. Instead, we brought $200,000 down to the table when we bought it, plus another $150 for rehab, plus $30,000 for little miscellaneous things. You know, we now have to bring another $50,000 to the table just to close the deal, just to get a 10% return, right? So before, it was going to be an infinite return. Partners were going to get their capital back. I was going to get my capital back. We're going to get rolling and hold this thing for a long time. Instead, now we're faced with a dilemma. Do we sell it? Do we bite the bullet for the 10% and bring the 50 G's and refi it? I don't know. What do you think? Put it down in the comments what you think. I really appreciate the input, to be honest with you. I've done this hundreds of times, and I'm sort of in this predicament where I think selling it might be best just to stay cash heavy. However, this is like an A-class property, and so holding this thing, there's no doubt this thing's worth $3 million in another 10 years, right? So why do I bring this up? Why did I make this video? To complain and tell you my story, blah, 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 blah. Here's why. This is going to present a massive opportunity for real estate investors looking to buy multifamily property, especially commercial size, because this is what was happening the last couple of years. People were seeing interest rates at 3-4%, right? They're able to go get bridge debt, only put 10% down. Essentially, it's like a walk-by appraisal. It's very easy to get bridge money, hard money, right? And so they'd come into this with 10% down, have an 8 to 10% interest rate on their bridge payment, but they're balloon payments, right? They're interest-only balloon payments. So what happens now is when you go to refinance out of that bridge debt and into long-term 25 to 30-year debt with agency financing or a local credit union or bank, with interest rates at 6.5%, instead of that cap rate compression that we saw due to low rates, now rates are increasing. Now cap rates are going to increase, cash flow is going to decrease, values are going to come down, and now when you go to refinance, well, guess what? First of all, your after repair value, gone. It's now worth much less. Your cap rate that you used, it's much higher, so your values drastically drop. Your cash flow is going to drop. Now, I'm not saying your rents are going to drop. In fact, your rents might go up a little bit, but here's the thing. Going up $100 a month in rent across 10 units is $1,000 a month, right? So that's $12,000 a year, and if what is that? That's a couple $100,000, right? At the end of the year when you use your cap rate metrics, depending on where you live. But with a 6.5% interest rate, it's not going to be able to keep up. And so people who are stuck with this bridge debt and hard money are either going to have to refi, bite the bullet, infuse more money, and give their investors a poor return, or they're going to have to fucking fire sale these things. And guess what? That's where you come in, right? This is where investors like myself, like you, come into play, scoop these things up for cheap, bite the bullet on the interest rate, and then refi again when they come back down in 24, 48, 60, whatever, how many months it is down the road. So I really see a huge opportunity here. If you guys want to learn how to find off-market deals through direct mail marketing, which I think is gold for this opportunity right here, and I am doing this, I've been doing it for 7 years and I continue to do this, please check the link in the below. I'll put the description somewhere in this video as well. It's $299, it's a course, it's pretty cheap. I've made millions of dollars using the tactics that I put in this course. For that amount of price, guys, it's a no-brainer. I go buy the friggin' thing, watch it, leave your feedback in the comments on this video if you want me to include more things, if you didn't like it, if you want whatever, more advice on certain things, I'd really appreciate it. I give my whole vendor list, everything, right? Anyways, I really hope you guys liked the video. I hope you guys can learn something from this, and moving forward, start to look for opportunities like this. Now, it's not just multifamily properties that are gonna have this issue. People who are flipping property, it's the same thing, right? The buying power has dropped, interest rates are higher, your ARV is not as high. That first-time home buyer coming in isn't going to be able to purchase the same amount of property, therefore your value is going to drop, and guess what? People are now stuck with the property. So now you can come in and buy rehabbed properties or close to rehab properties for undervalued prices. Now, I'm not saying you're going to be able to flip them every time, but you can hold them, you can rent them, you can wait a while and then refi when it's low, or you can, there's a bunch of different options, but I think this is a great opportunity and a great time for investors to be looking long-term buy and hold properties. Thanks, guys. I appreciate it. Please comment on the video. Please hit the subscribe button. It really helps more people get these videos and get this content, right? That's the whole purpose we're doing this. Free info for you guys. Thank you very much. Have a good day.